Before we begin, please remember that this presentation is for informational and educational purposes only. I am not a financial advisor, loan officer, or real estate agent. The information provided in this video does not constitute financial, legal, or real estate advice. You should always consult with a qualified and licensed professional before making any major financial decisions, especially those related to purchasing a home. All examples are illustrative, and your individual results will vary. What if I told you there's a way to buy a home in the United States with absolutely $0 for a down payment? Not 3%, not 5%. Zero. What if I told you that you could also completely avoid paying that frustrating monthly fee called private mortgage insurance, or PMI, saving you hundreds of dollars every single month for years? And what if, on top of all that, you could secure an interest rate that is consistently lower than what the average person gets on a conventional loan? It sounds like a late-night infomercial, a gimmick, or some kind of too-good-to-be-true scam. But it's not. It is one of the most powerful and underutilized financial benefits in this country. It's the VA home loan. And if you have served in the United States military, this benefit was earned by you for you. But let's be real. For most people, and maybe for you, the dream of owning a home feels like it's drifting further and further away. You watch the news, you see the housing prices, you hear the interest rates, and it feels impossible. You're working hard, you're trying to save, but that massive 20% down payment that everyone talks about feels like a mountain you can never climb. You see friends struggling, scraping together every last penny, only to be hit with thousands in closing costs, and that soul-crushing PMI payment tacked onto their mortgage every month. It's a system that feels designed to keep people out. And maybe you've even heard of the VA loan, but you've also heard the rumors, the myths, the barracks lawyer talk that surrounds it. Oh, the VA loan is a nightmare to get. Sellers hate VA offers. They'll never accept it. It's a one-time only benefit, so you have to save it for your forever home. The inspections are impossible to pass. The funding fee is too expensive. I'm here to tell you that nearly all of that is either completely false or a massive misunderstanding of how this program actually works. The truth is, the VA Home Loan Guarantee Program is not a handout. It's a handshake. It's a thank you from a grateful nation, designed specifically to help service members, veterans, and eligible surviving spouses become homeowners. It was signed into law back in 1944 as part of the original GI Bill, with the express purpose of opening the doors to homeownership for those who served. And for over 75 years, it has helped millions of military families build wealth and plant roots in the communities they fought to protect. The problem is, nobody gives you a manual for this when you leave the service. They hand you your DD-214, shake your hand, and send you on your way. You're left to navigate the most complex financial decision of your life on your own, surrounded by misinformation. That ends today. Over the next 10 parts, we are going to create that manual together. This isn't just another video with surface-level tips. This is a masterclass. This is your definitive guide to understanding, qualifying for, and successfully using your VA home loan benefit to its absolute maximum potential. We are going to demystify the entire process from start to finish. We will crush the myths with cold, hard facts. We will give you the language to speak confidently with real estate agents and lenders. We will show you the exact steps to take, and more importantly, the pitfalls to avoid. My promise to you is this. If you stick with me through this series, you will walk away with the knowledge and confidence to use your VA loan benefit not just once, but multiple times, to buy a home with little to no money out of your own pocket. You will learn how this single benefit can become the cornerstone of your family's financial future. So let's start by tackling the biggest myths head-on right now. Myth number 1. You can only use the VA loan once. This is one of the most damaging and widespread falsehoods out there. It causes people to sit on the sidelines for years, waiting for the perfect house, afraid to waste their benefit. The truth is, the VA loan is a lifetime benefit that you can use over and over again. You can buy a home, live in it, sell it, and then use your VA loan again to buy another one. You can even, in many cases, have more than one VA loan at the same time. We will dedicate an entire part of this series to explaining exactly how your entitlement works and how you can restore it to use it again and again. Myth number 2. Sellers won't accept VA offers. This is a big one. You'll hear that sellers and their agents are scared of VA loans because they think the appraisals are too strict or the process is too slow. While this might have had a sliver of truth decades ago, the modern VA loan process is incredibly streamlined. In many cases, it's just as fast, if not faster, than a conventional loan. The VA's appraisal standards, known as minimum property requirements or MPRs, are simply there to ensure the home you're buying is safe, sound, and sanitary. It's a feature designed to protect you, the veteran buyer, from buying a lemon. And when you have a great real estate agent who knows how to communicate the strength of a VA-backed offer, which is one of the most secure forms of financing on the planet, sellers are more than happy to accept it. Myth number 3. The VA funding fee makes it too expensive. Okay, let's talk about this. Most veterans who use the VA loan will have to pay a one-time fee called the VA funding fee. This fee goes directly to the Department of Veterans Affairs to keep the program running for future generations with no taxpayer burden. Now, here's the critical part people miss. First, this fee can be rolled into the total loan amount, meaning you don't have to pay it out of pocket. Second, and most importantly, this fee allows you to avoid paying monthly private mortgage insurance. PMI on a conventional loan can cost you hundreds of dollars every month, potentially for the entire life of the loan. The one-time funding fee is almost always drastically cheaper in the long run than paying monthly PMI for years on end. And here's the kicker. If you are a veteran receiving VA disability compensation, you are completely exempt from paying the funding fee altogether. That's a potential savings of thousands of dollars right at closing. This is just the tip of the iceberg. We're going to cover eligibility, who exactly qualifies from active duty to National Guard and Reserve members. We'll break down the Certificate of Eligibility, or COE, and show you how to get yours in minutes. We'll guide you on how to find a rockstar lender and a military-friendly real estate agent who truly understands the power of this loan. We'll walk through the entire process from pre-approval to the day you get the keys in your hand. The ability to buy a home with no money down is a financial superpower. It allows you to get into the real estate market and start building equity years before you would have been able to otherwise. While everyone else is struggling to save up tens of thousands of dollars for a down payment, you can be moving into your own home, your monthly payment building your own wealth instead of your landlord's. So if you're tired of renting, tired of feeling like homeownership is out of reach, and you're ready to take control and use the powerful benefits you rightfully earned through your service to this country, you are in the exactly right place. Get ready to take notes, because we're about to change your financial future, and it all starts with understanding the very first step in the process, proving you've earned it. This proof, this golden ticket, has a name, the Certificate of Eligibility, or COE. It's the single most important document in the entire VA loan process. Think of it like this. The VA home loan is a treasure chest filled with incredible benefits. No down payment, no private mortgage insurance, amazing interest rates. But that chest is locked. The Certificate of Eligibility is the key. Without it, you can't even get close. It is the official, non-negotiable proof from the Department of Veterans Affairs that you have met the minimum service requirements to participate in the program. It tells the lender, yes, this person has served. They are one of us. They are eligible for this benefit. So, who gets a key? Who has earned this right? The answer is broader than many people think, and this is where we need to get specific because details matter. Let's break down the primary categories of eligibility. First, let's talk about our veterans. If you are no longer serving, your eligibility generally depends on when and for how long you served. The VA has different rules for different eras of service. For veterans who served during wartime, the requirement is typically 90 consecutive days of active service. Think of periods like the Gulf War from August 2, 1990 to the present. If you served on active duty for at least 90 days straight during this time, you've likely met the bar. For veterans who served during peacetime, the bar is a little higher. The requirement is typically 181 consecutive days of active service. So if your service fell between, say, 1980 and 1990, this is the rule that would likely apply to you. Now, there's a critical exception to these timeframes. If you were discharged for a service-connected disability, those minimum service days, the 90 or the 181, are waived. Let me repeat that because it is vital. If you were honorably discharged because of an injury or disability that was a result of your service, it doesn't matter if you served for 80 days or 8 days. Your sacrifice is recognized and you are eligible. Period. Next, what if you are still serving? For our active duty service members, the path is even more straightforward. Once you have served for 90 consecutive days on active duty, you are eligible to apply for a VA loan. You don't have to wait until you separate or retire. You can use this benefit right now to buy a home for your family at your current duty station, or even prepare for your transition back to civilian life. This is a powerful tool for building wealth and stability while you are still in uniform. But what about the backbone of our military forces, the members of the National Guard and the Reserves? For a long time, the path to a VA loan was much harder for you. But thankfully, that has changed. The rule now is this: you need to have 6 years of honorable service in the selected Reserve or National Guard. Once you hit that 6-year mark, you've earned your eligibility. However, just like with active duty, there are important exceptions. If you were called to active duty under Title 10 orders, meaning you were activated for federal service, not state service, the rules for active duty apply. That means you only need 90 days of that federal active service to become eligible. This is a huge deal for Guard and Reserve members who have been deployed in support of operations overseas. Your federal deployment time counts, and it can make you eligible far sooner than the standard 6-year rule. Finally, there is one more category that is incredibly important, but often overlooked: surviving spouses. This benefit doesn't die with the service member. The VA loan program extends to the unremarried spouses of service members who died in the line of duty or as a result of a service-connected disability. It also extends to the spouses of service members who are missing in action or are prisoners of war. This is a sacred promise. It's a recognition that the spouse's sacrifice is also profound, and it's a way to provide lasting stability to the families of our fallen heroes. If you are a surviving spouse, you need to know this benefit is for you. So, to recap, veterans with 90 days of wartime service or 181 days of peacetime service, active duty members with 90 days of service, Guard and Reserve members with 6 years of service or 90 days of federal activation, and certain surviving spouses. These are the gates to eligibility. Now, knowing you're eligible is one thing. Proving it is another. This brings us back to that all-important document, the Certificate of Eligibility. How do you actually get this piece of paper in your hands? You have 3 primary ways to do it, and the one you choose can dramatically affect the speed and smoothness of your home buying journey. The first, and by far the most common and recommended method, is to have a VA-approved lender get it for you. This is the path of least resistance. Experienced VA lenders have access to a special system called the Web LGY system, which is the VA's online portal. In a matter of minutes, they can input your information and, in most cases, generate your COE on the spot. It's fast, it's efficient, and it takes the burden off of you. You're focused on finding a home. Let your lender handle this piece of administrative legwork. All you typically need to provide is your Social Security number and date of birth. The system does the rest. However, sometimes the system can't automatically verify your service. This is common for older veterans or some Guard and Reserve members whose records aren't fully digitized. If that happens, you'll move to Option 2. Option 2 is to apply for your COE online yourself. You can do this through the VA's e-benefits portal. You'll need to log in with your DS Logon, ID.me, or another verified account. From there, you can navigate to the Housing Benefits section and apply for the COE. This route requires you to upload your proof of service documents yourself. For most veterans, this means your DD-214 Member 4 copy. For active duty, it's a statement of service signed by your commander. For Guard and Reserve, it's your latest annual retirement points summary. This method gives you direct control, but it can take longer for the VA to process your request and mail you the certificate. The third and slowest option is to apply by mail. You would fill out VA Form 26 to 1880, the request for a certificate of eligibility, and mail it to the VA's Regional Loan Center along with your proof of service. This is the old-school way. It works, but in a fast-moving real estate market, waiting weeks for a piece of paper to come in the mail can mean the difference between getting your dream home and watching it get sold to someone else. Time is of the essence. So, the clear winner for most people is to work with a great VA lender who can pull the COE for you almost instantly. It's the first sign that you're working with a professional who understands the system and is ready to make the process easy for you. Getting your COE is the official starting pistol for your VA home loan journey. It's the moment the abstract idea of a benefit you earn transforms into a tangible asset you can use. It's the VA officially saying, "Welcome, you've done your part. Now let us do ours." So you have your COE in hand. You've proven you're eligible. You're ready to go, right? Not so fast. Because having eligibility is one thing, but having enough eligibility, what the VA calls your entitlement, is a completely different game. And misunderstanding this one concept is the #1 reason veterans get their dream home snatched away at the last second. It's the hidden detail that determines how much you can actually borrow with zero down payment. In the next part, we're going to break down VA loan entitlement basic and bonus, and show you how to calculate exactly how much house you can afford, ensuring you have the firepower to win the home you truly deserve. So let's dive straight into the heart of the VA loan's power: entitlement. This is the term you'll hear over and over, and frankly, it's one of the most misunderstood parts of the entire process. But by the end of this section, you'll understand it better than 99% of people out there, including many loan officers. First, let's clear up a huge misconception. Your VA loan entitlement is not a pile of cash. The VA isn't handing you a check. Instead, think of it as a promise, a guarantee, or a voucher that you give to a private lender like a bank or a mortgage company. This voucher tells the lender, hey, if this veteran or service member defaults on their loan, the Department of Veterans Affairs has your back. We will cover a portion of your losses. Specifically, the VA guarantees up to 25% of the loan amount. That's the magic number, 25%. This guarantee is what makes lenders feel so secure. It dramatically reduces their risk, which is why they are willing to offer you, the veteran, such incredible terms, like zero down payment and no monthly mortgage insurance. They have a safety net, and that safety net is your entitlement. Now let's break down the two types of entitlement, basic and bonus. Everyone who is eligible for a VA loan starts with what's called basic entitlement. This amount is $36,000. I know what you're thinking. $36,000? How am I supposed to buy a house with that? Remember, it's not the loan amount, it's the guarantee. For decades, that $36,000 guarantee was used to calculate the maximum loan you could get with zero down payment. Since the VA guarantees 25%, or 1/4 of the loan, you simply multiply that guarantee by 4. So, $36,000 times 4 equals $144,000. For a very long time, that was the effective limit for a zero down VA loan. If you wanted to buy a more expensive house, you had to come up with a down payment. But then everything changed. In 2020, thanks to the Blue Water Navy Vietnam Veterans Act, the game was completely rewritten for veterans with their full entitlement. The old loan limits set by the Federal Housing Finance Agency were effectively eliminated for VA borrowers. This is a monumental benefit. If you have your full, first-time use entitlement, there is no official VA loan limit. Let me say that again. There is no official VA loan limit. This means if you have your full entitlement, a lender can approve you for a $1 million home, a $2 million home, or more with zero down payment, as long as you can financially qualify for that monthly payment based on your income and credit. The VA will still guarantee 25% of that massive loan. This change single-handedly made the VA loan the most powerful home financing tool on the planet for those who have earned it. But what if you've used your VA loan before? What if you bought a home a few years ago, and now you're getting PCS orders to a new duty station, and you want to keep your first home as a rental property and buy a new one? This is where bonus entitlement, also called Tier 2 entitlement, becomes your superpower. Bonus entitlement allows you to have more than one VA loan at the same time. It's a reusable benefit. This is how it works. The VA calculates your remaining entitlement based on the current year conforming loan limits for your county. For most of the country in 2024, that limit is $766,550. In high-cost areas like parts of California or Hawaii, it can be over $1 million. The VA's maximum guarantee is based on 25% of that conforming loan limit. So, for most of the country, we take that $766,550 and multiply it by 25%. That gives us a total possible guarantee of $191,637.50. Now let's walk through a real-world example. Let's say you're an Army captain. A few years ago, you used your VA loan to buy a $200,000 condo near your first duty station. You've now decided to keep it and rent it out for passive income. How much of your entitlement did you use on that first home? The VA guaranteed 25% of that $200,000 loan, which is $50,000. So, you have $50,000 of your entitlement tied up in that first property. To figure out your remaining bonus entitlement, you take the VA's maximum possible guarantee, that $191,637, and you subtract the $50,000 you've already used. That leaves you with $141,637 of remaining entitlement. That's your remaining guarantee. That's the voucher you have left to give to a lender for your next home. So, how much house can you buy with that remaining guarantee? We do the same math as before. We take your remaining guarantee and multiply it by 4. So, $141,637 times 4 equals $566,550. That is the maximum loan amount you can get for your second home with absolutely zero money down. You can be a landlord, earning rental income on your first property, while simultaneously buying a beautiful new home worth over $500,000 at your next duty station, again with no down payment. That is the incredible power of bonus entitlement. But what if the home you want costs more than that? Let's say you find the perfect house, but it's $600,000. Your max zero down loan is $566,550. Are you out of luck? Absolutely not. You can still buy that house. The VA loan simply requires you to put down a down payment equal to 25% of the difference. Let's do the math. The purchase price is $600,000. Your max zero down loan is $566,550. The difference is $33,450. You need to pay 25% of that difference as a down payment. So, 0.25 times $33,450 is $8,362.50. That's your down payment. Just over $8,000 to buy a $600,000 home. Now, compare that to a conventional loan. Even with a minimal 5% down payment on a $600,000 house, you'd need to bring $30,000 to the table, plus you'd be stuck paying expensive private mortgage insurance every single month. With the VA loan, you save over $21,000 on the down payment alone, and you still have no PMI. The benefit is undeniable. Finally, you might be wondering, can I ever get my full entitlement back? Yes, you can. It's called restoration of entitlement. This typically happens in one of three ways. 1. You sell the property you bought with the VA loan and the loan is paid off in full. 2. Another eligible veteran formally assumes your loan, substituting their entitlement for yours. Or 3. You refinance your VA loan into a non-VA loan like a conventional loan, which pays off the original VA loan. Once that VA-backed loan is gone, you can apply to have your full entitlement restored to its original, powerful state, ready for your next home purchase. Understanding entitlement is the key to unlocking the full financial firepower of your VA loan benefit. It's not just a one-time deal. It's a flexible, reusable tool that can help you build wealth through real estate throughout your life and career. It adapts with the market, it allows for multiple properties, and it provides a clear path to homeownership that is simply unmatched. So you understand the buying power, but what about the costs? There's one fee unique to the VA loan that everyone asks about, and in some cases you don't have to pay it at all. In the next part, we're demystifying the VA funding fee, what it is, who pays it, and the critical exemptions that could save you thousands of dollars right at the closing table. So let's dive right into it. The VA funding fee. This is the one fee unique to the VA loan that causes the most confusion, but understanding it is the key to unlocking the program's full potential. So what is it? Put simply, the VA funding fee is a one-time fee paid directly to the Department of Veterans Affairs. It's not a fee your lender pockets. This fee is the engine that keeps the entire VA loan program running. Because of this fee, the VA can guarantee a portion of your loan, which gives lenders the confidence to offer you those incredible benefits we talked about: zero down payment and no monthly mortgage insurance. Think of it this way. Instead of paying hundreds of dollars every single month for PMI, you pay a one-time fee that helps the next generation of veterans buy their own homes. It's a system of veterans helping veterans, and it's what makes the whole program financially sustainable for the U.S. taxpayer. Now the big question, how much is it? This isn't a single flat number. The fee is a percentage of your total loan amount, and that percentage changes based on three critical factors. First, your branch of service. There's a slight difference for those in the National Guard or Reserves versus regular military. Second, whether this is your first time using a VA loan or a subsequent time. And third, the size of your down payment. Let's make this real with an example. Imagine you're an active duty service member buying your very first home for $400,000, and you're taking full advantage of that zero down payment benefit. For a first-time user with no money down, the funding fee is currently 2.15%. So, on that $400,000 loan, your funding fee would be $8,600. Now, before your heart skips a beat, remember what this fee replaces. On a conventional loan for $400,000 with zero down, if you could even find one, you'd be paying private mortgage insurance or PMI. That could easily be $300 to $400 per month. That's up to $4,800 a year every single year, until you've built up significant equity. That $8,600 one-time fee starts to look a lot better when you realize it saves you tens of thousands of dollars in PMI over the life of the loan. But here's where it gets even more interesting. The VA rewards you for putting money down. Let's take that same $400,000 house, but this time you decide to put down 5%, which is $20,000. Now your loan amount is $380,000. Because you made a down payment of 5% or more, your funding fee percentage drops significantly, down to just 1.5%. So now the fee is 1.5% of your new, lower loan amount of $380,000, which comes out to $5,700. By putting just 5% down, you saved almost $3,000 on the funding fee alone. The more you put down, the lower the fee gets. The other major factor is prior use. The VA loan is a benefit you can use over and over again. However, the funding fee is higher for subsequent uses. Let's go back to our veteran buying that $400,000 house with zero down. If this is their second time using a VA loan, the funding fee jumps from 2.15% to 3.3%. That's a difference of over $4,000. This is a crucial detail to factor into your long-term financial planning if you plan on moving and using the VA loan benefit again in the future. Okay, so you've calculated the fee. Now how do you actually pay it? This is arguably the best part. You do not have to bring thousands of extra dollars to the closing table. The vast majority of veterans choose to roll the funding fee directly into their total loan amount. So, in our first example, that $8,600 fee would be added to the $400,000 loan, making your total mortgage $408,600. Your monthly payment will be slightly higher to account for this, but it means you can get into the house with minimal cash out of pocket. This feature alone is what makes homeownership accessible for so many service members who have a steady income, but haven't had the chance to save up a huge pile of cash. Of course, you do have other options. You can pay the fee in cash at closing if you prefer to keep your loan balance lower. And here's a pro tip for all the savvy negotiators out there. You can ask the seller to pay the fee for you. This is called a seller concession. In a buyer's market, it's a powerful tool. Asking the seller to cover your funding fee can be a more attractive request than asking them to simply lower the price, and it achieves the same goal of reducing your upfront costs. Now, we've talked about what the fee is, how it's calculated, and how you can pay it. But what if I told you that for a huge number of veterans the funding fee is zero? What if you were completely exempt from paying it at all? This is not a loophole. It's a core feature of the program designed to assist those most affected by their service. You are completely exempt from paying the VA funding fee if you are a veteran receiving any amount of compensation for a service-connected disability. Let me repeat that, any amount. It doesn't matter if your VA disability rating is 10% or 100%. If you are receiving disability payments, you do not pay the funding fee. On a $400,000 loan, that's an instant savings of thousands, or even tens of thousands of dollars. This exemption also extends to veterans who would be entitled to receive disability compensation, but are receiving active duty or retirement pay instead. This is a critical distinction that many people miss. It also applies to surviving spouses of veterans who died in service or from a service-connected disability. And thanks to a more recent change, active duty service members who have been awarded the Purple Heart are also now exempt from the funding fee. So how does the VA know you're exempt? It's usually an automatic process. When your lender requests your Certificate of Eligibility, or COE, which is the document that proves you're eligible for the loan, it will typically state exempt right on it if you meet the criteria. Your lender sees that and the fee is waived. Simple as that. But what if your disability claim is still pending when you're closing on your home? This is a fantastic question. If you have a claim that is pending, you will likely have to pay the funding fee at closing. However, if your disability claim is later approved and the effective date is prior to your closing date, you can apply to the VA for a full refund of the funding fee you paid. That's right, the VA will send you a check for the entire amount. This is a life-changing piece of information that could put thousands of dollars back in your pocket. Finally, it's worth noting the funding fee also applies to VA refinances, but in a different way. For the super popular Interest Rate Reduction Refinance Loan, or IRRL, the fee is a tiny, flat 0.5% for everyone. It's incredibly low. For a cash-out refinance, the fees look more like the purchase loan fees we already discussed. So, to recap, the funding fee is what makes this incredible loan program possible. It replaces a lifetime of expensive PMI with a single one-time payment. Its cost depends on your service, your down payment, and whether you've used the loan before. It can be conveniently rolled into the loan itself, so you don't need cash. And most importantly, if you are a veteran with a service-connected disability, a Purple Heart recipient, or a qualifying surviving spouse, you are completely exempt from this fee. saving you a fortune right from the start. So you know the costs, you know you might be exempt from the biggest one, but how do you actually prove to a lender that you're eligible for this incredible benefit in the first place? It all comes down to one single critical document: your certificate of eligibility. In the next part, we'll break down exactly what the COE is, the 3 ways you can get it, including the secret fastest way your lender can do it for you in minutes, and what the term entitlement really means for your buying power. So, let's talk about this key to the kingdom, the certificate of eligibility, or COE. Think of it as your official via-stamped passport to homeownership. It's the one piece of paper that proves to a lender that you have, in fact, earned this benefit. Without it, a lender can't even begin the VA loan process. It's a non-negotiable. It's the starting pistol for the entire race. So, how do you get your hands on this critical document? There are essentially 3 paths you can take. 2 of them you can do yourself, and one is a little-known secret that the best lenders use to make your life incredibly easy. Let's start with the old-school way, snail mail. This is the path of maximum patience. You'll need to find and fill out VA Form 26 to 1880, the request for a certificate of eligibility. You'll gather your proof of service like your DD-214, make copies, stuff it all into an envelope, put a stamp on it, and send it off to the VA's regional loan center. Then you wait, and wait. It could be weeks, even over a month, depending on their workload. If you filled out the form incorrectly, or forgot a document, that envelope gets sent right back to you, and the clock starts all over again. In a hot housing market where days, even hours, can matter, this is like choosing to ride a horse to a Formula One race. It's scenic, I guess, but you're going to lose. The second path is much better, going online. This is the DIY digital route. You can log into the VA's eBenefits portal with your credentials. You'll navigate through the menus, find the home loan section, and request your COE electronically. For many veterans whose records are easily accessible in the VA system, this can be almost instantaneous. The system verifies your service and boom, a PDF of your COE is generated, ready for you to download. It's faster, it's more efficient, and you have control over the process. This is a great option if you're comfortable navigating government websites and want to have the document in your hands before you even speak to a lender. But now let's talk about the third way, the secret fastest way. The one that separates the average lenders from the VA loan pros. Nearly all VA-approved lenders have access to a system called WebLGY, which is the VA's own online portal for lenders. A skilled loan officer can take your basic information, your name, social security number, and date of birth, log into this system, and in about 99% of cases, pull your certificate of eligibility in less than 5 minutes. Seriously, while you're still on the phone with them. It's that fast. They bypass the mail, they bypass you having to fumble around on a website, and they get the exact document they need, instantly. If a lender tells you that you need to go get your COE and bring it to them, it might be a subtle red flag that they aren't very experienced with the VA loan process. A pro will just say, "Don't worry about it, I'll pull it for you right now." So now you have your COE. You're looking at this official document and you see a key term on it, entitlement. This is, without a doubt, one of the most misunderstood aspects of the entire VA loan. When people hear entitlement, they often think it's a specific amount of money like a grant. That's not it at all. VA loan entitlement is not cash. It's a guarantee. It's the VA's promise to your lender. It's the Department of Veterans Affairs stepping up and telling the bank, "Hey, we vouch for this veteran. If, in a worst-case scenario, they can't make their payments and the loan goes into foreclosure, we will cover a portion of your losses." This guarantee is what makes you, the veteran, such a low-risk borrower in the eyes of the lender. It's why they're willing to give you a loan with 0 down payment and fantastic interest rates. The VA is essentially your cosigner, and the entitlement amount is the limit of their cosigning promise. Now let's break down that promise. Every eligible veteran starts with what's called basic entitlement, which is $36,000. And right away, I know what you're thinking. $36,000? What kind of house can I buy with that? And you're right to ask, because that number is incredibly misleading. Lenders are typically willing to loan up to 4 times the amount of your available entitlement. So, that basic $36,000 entitlement traditionally meant the VA was guaranteeing enough for a lender to feel comfortable loaning you up to $144,000 with no down payment. For years, this was tied to something called the conforming loan limit, which is set by the Federal Housing Finance Agency and varies by county. But here's where it gets amazing. A few years ago, the Blue Water Navy Vietnam Veterans Act of 2019 completely changed the game. For veterans with their full, basic entitlement available, meaning you've never used your VA loan before, or you've used it but sold the property and had your entitlement fully restored, the VA loan limit was effectively eliminated. Let me repeat that because it's a benefit that is almost too good to be true. If you have your full entitlement, there is no official VA loan limit. You can buy a $500,000 house, an $800,000 house, $1 million house or more with zero down payment, as long as you can medically, financially qualify for that loan amount with the lender. The VA removed the ceiling. That $36,000 basic entitlement is still on the books, but for first-time users it's almost a technicality. Your buying power is now limited only by your income and credit profile, not by an arbitrary government cap. But what if you don't have your full entitlement? This is where it gets even more interesting, and where the VA loan reveals its incredible flexibility. This leads us to something called bonus entitlement, or Tier 2 entitlement. This is for veterans who already have an active VA loan, or who may have lost a previous VA loan to foreclosure. Let's say you're an active duty service member. You bought a home at your first duty station for $250,000 using your VA loan. Now, you have PCS orders to move across the country. You don't want to sell that first house. It's a great property, and you want to keep it as a rental. Can you get another VA loan for a new house at your next duty station? The answer is a resounding yes. This is where we do a little math. The VA guarantees 25% of the loan. On your first $250,000 home, you used up $62,500 of your entitlement guarantee. But your total entitlement is much higher than that, thanks to the bonus entitlement, which is calculated based on those county loan limits. Let's say the limit in the county where you're buying your new home is $766,550 for this year. The VA will guarantee up to 25% of that figure, which is $191,637.50. So, you subtract the entitlement you've already used on your first home from that total. You still have a significant amount of entitlement left over that you can use to purchase that second home, often with zero down payment. You can own 2 homes in 2 different cities at the same time, both with VA loans. This is a powerful tool for building real estate wealth that most people have no idea even exists. Finally, there's one other critical piece of information on your COE, your funding fee status. You'll see a code, and next to it, it will likely say exempt or NON exempt. If you are a veteran receiving VA disability compensation, or a surviving spouse, your certificate will say exempt. This means you do not have to pay the VA funding fee, a one-time fee rolled into most VA loans. This exemption can save you thousands, sometimes tens of thousands of dollars at the closing table. It's a massive financial advantage. We're going to do a deep dive on the funding fee in a later part, but for now, just know that your COE holds the key to whether you have to pay it or not. So you have your COE, you understand your entitlement is a powerful guarantee, not cash, and you know that for most of you, there is no limit to what you can borrow with zero down. You're ready to go, right? You're basically approved. Not so fast. Getting the green light from the VA is only step 1. The real gatekeeper is the lender, the institution that's actually writing the check for your new home. And while the VA sets the foundation, the lender builds the house on top of it, with their own set of rules, their own requirements, and their own deal breakers. In the next part, we're going to shatter the common myths about VA loan credit scores and reveal the one number that underwriters obsess over more than anything else: your debt-to-income ratio and something called residual income. So let's talk about that magic 3-digit number that so many people believe is the ultimate gatekeeper to homeownership: your credit score. The biggest myth, the one that stops countless veterans from even trying, is that you need a specific high credit score to qualify for a VA loan. Let me be as clear as possible. The Department of Veterans Affairs itself sets absolutely no minimum credit score requirement. 0. It's not in their guidelines. They don't have a magic number like 620, 640, or 700 that automatically gets you in or keeps you out. So why then does every article you read, every forum you visit, and maybe even the first lender you called all talk about a minimum score? The answer lies in something called lender overlays. Imagine the VA sets the baseline rules for the game. They say, here's the field, here are the basic rules for how to play. But then the individual lenders, the banks, the credit unions, the mortgage companies, they get to add their own house rules. They might say, okay, we'll play by the VA's rules, but on our team, you also have to be able to run a 7-minute mile. That 7-minute mile is a lender overlay. It's an extra requirement the lender adds on top of the VA's guidelines to reduce their own risk. Most lenders use credit scores as a quick and easy way to gauge risk. A higher score generally means you have a history of paying your bills on time. It's a snapshot of your financial past. So, they slap on a minimum score requirement, often 620 or 640, because it's a simple filter. It helps them sort through thousands of applications quickly. But the VA loan program was designed to look deeper than that. It was designed to see the whole person, the whole financial picture, not just a single number that reflects a moment in time. And that's why the VA pushes underwriters to focus on two other numbers that tell a much more compelling story about your ability to actually afford a home, right now and in the future. The first and most important is your debt-to-income ratio, or DTI. Your DTI is the heavyweight champion of your loan application. It's a simple percentage that shows how much of your monthly gross income, that's your income before taxes, is already spoken for by debt. Think of it like this. If you bring home a pie every month, DTI measures how many slices of that pie are already promised to someone else before you even get to take a bite. The calculation is straightforward. You add up all your monthly debt payments. This includes things like your car payment, student loans, credit card minimum payments, and any other installment loans. You do not include things like your grocery bill, gas, or utilities. Then you divide that total monthly debt by your total gross monthly income. For example, let's say you earn $6,000 a month before taxes. And let's say your monthly debts are a $400 car payment, a $200 student loan payment, and a $100 minimum credit card payment. Your total monthly debt is $700. You divide $700 by $6,000, and you get about 11.6%. That's your current DTI. Now, the lender will add in your proposed new mortgage payment. If your estimated new house payment, including principal, interest, taxes, and insurance, is say $1,800, your total monthly obligations would become $2,500. Divide that by your $6,000 income, and your new DTI is about 41.6%. The VA's general guideline is that they prefer to see a DTI of 41% or less. But here is the crucial difference, the part that makes the VA loan so powerful. That 41% is a guideline, not a guillotine. It's a soft line in the sand, not a brick wall. Lenders can and frequently do approve loans with DTIs of 45%, 50%, or even higher. How is that possible? Because of the VA's secret weapon, the second number that underwriters truly obsess over, residual income. If DTI is about what you owe, residual income is about what you have left. It is the single most important factor in a VA loan approval. Residual income is the net effective income you have left over each month after you pay all of your major expenses, including your new mortgage payment, property taxes, estimated utilities, and all your other debts. This isn't just about paying the bank. This is about having enough money left over to live, to buy food, to put gas in the car, to handle a flat tire, to buy your kid a birthday present without going into a financial tailspin. The VA's philosophy is rooted in a powerful idea. They don't just want to get you into a house. They want you to stay in that house. They want you to succeed. The number one cause of foreclosure isn't losing a job. It's families being stretched so thin that a single minor financial emergency becomes a catastrophe. Residual income is the VA's way of building a financial buffer right into your approval. They have a table that specifies the minimum amount of residual income your family needs based on your family size and the region of the country you live in. For example, a family of 4 living in the Midwest might need to have at least $1,003 left over each month. That same family of 4 living in the more expensive West region would need $1,158. The VA literally calculates your estimated monthly cost for things like electricity, gas, and water based on the square footage of the home you want to buy, and they factor that in. They are looking at the real, on-the-ground cost of living. This is where the magic happens. This is how a veteran with a 50% DTI can get approved. The underwriter looks at the file and says, okay, a 50% DTI is high. On a conventional loan, this would be an automatic denial. But let's look at the residual income. The guideline for this family of 4 in Texas is $1,003 a month. After we calculate everything, the new mortgage, the car payment, the estimated utilities for a 2,000 square foot house, they have $1,800 a month left over. That's nearly double the requirement. In that moment, the entire risk profile changes. The high DTI becomes less of a concern because the strong residual income proves that the family has more than enough cushion to handle their obligations and still live comfortably. A strong residual income can overcome a high DTI. It can overcome a less than perfect credit score caused by some medical bills a few years ago. It tells the underwriter a story of financial stability that a simple credit score never could. It shows you can manage your money and have the capacity to weather life's small storms. So what does this mean for you right now? It means you need to shift your focus. Stop obsessing over that FICO score you see on a free credit app. Instead, do two things. First, calculate your DTI. Get a clear picture of where you stand. Second, and more importantly, work with a lender who truly understands the power of residual income. A loan officer who just says, "Sorry, our minimum score is 640, isn't doing the work. A true VA loan specialist will say, "Okay, your score is a little low, and your DTI is a bit high, but let's calculate your residual income. Let's see what story the numbers really tell." Because in the world of VA loans, your ability to live, not just your history of debt, is what truly matters. Now you know the financial metrics that truly define your eligibility. But there's one unique cost associated with the VA loan that can be rolled right into your mortgage, and in some cases waived entirely. It's called the VA funding fee, and understanding how it works can save you thousands of dollars right from the start. We're going to break down exactly what it is, who has to pay it, and the critical exemptions that could eliminate it for you completely. So let's pull back the curtain on this thing. The VA funding fee is a one-time fee paid to the Department of Veterans Affairs. Think of it as the insurance policy for the entire VA loan program, since the VA is guaranteeing a portion of your loan to the lender, which is why lenders are willing to offer such incredible terms like zero down payment and no private mortgage insurance. This fee is what funds that guarantee. It's what keeps the whole system healthy and available for future generations of veterans. Without it, the program simply couldn't exist in its current form. So instead of paying a monthly mortgage insurance premium, or PMI, for years and years, which can add up to tens of thousands of dollars, most VA borrowers pay this one-time fee up front. When you look at it that way, it's an incredible trade-off. Now the big question, how much is it? This is where it gets interesting because the fee isn't a single, flat number. It's a percentage of your total loan amount, and that percentage changes based on three key factors. First, the type of loan you're getting, like a purchase or a refinance. Second, the size of your down payment if you choose to make one. And third, whether this is your first time using your VA loan benefit or a subsequent time. Let's break it down with a real-world example. Imagine you're buying a home for $400,000. For most first-time users who are active duty, veterans, or in the Guard or Reserves, if you choose to use the famous zero down payment option, your VA funding fee will be 2.15% of the loan amount. On that $400,000 loan, that comes out to $8,600. Now you might be thinking, wow, $8,000 is a lot of money. And it is. But remember what you're getting in return. You're avoiding a down payment that could be $20,000 or more on a conventional loan, and you're completely sidestepping monthly PMI, which could easily be $200 or $300 a month every single month for years. But here's where you can be strategic. The VA rewards you for putting some skin in the game. If you put down at least 5% but less than 10%, that funding fee drops significantly, all the way down to 1.5%. On our $400,000 home, a 5% down payment is $20,000. Your new loan amount would be $380,000, and the 1.5% funding fee on that would be $5,700. By making a down payment, you just saved yourself almost $3,000 on the fee alone. If you can put down 10% or more, the fee drops even further to 1.25%. The system is designed to give you options and reward you for reducing the lender's risk. Now, what if this isn't your first rodeo? What if you've used a VA loan before? For subsequent use, the fees are a bit higher. This is because the VA assumes a slightly higher risk on repeat borrowers. For a zero-down loan on your second, third, or fourth VA-backed home, the funding fee is 3.3%. On that same $400,000 loan, that's $13,200. Again, this might seem steep, but it's crucial to weigh it against the alternatives. A conventional loan would still require a hefty down payment and PMI. So even with the higher subsequent use fee, the VA loan often comes out far ahead financially. And just like with the first-time use, putting money down will reduce that fee. A 5% down payment drops the subsequent use fee to 1.5%, and a 10% down payment drops it to 1.25%, the exact same reduced rates as a first-time user. It's also important to know that these percentages are for purchase loans and cash-out refinances. If you're doing what's called an interest rate reduction refinance loan, or an IRRL, which is a streamlined way to lower your interest rate on an existing VA loan, the funding fee is much lower, just 0.5% for everyone, regardless of whether it's your first or subsequent use. So you've figured out what your fee will be. The next question is, how do you pay it? Do you need to show up to closing with a check for thousands of dollars? Thankfully, no. While you absolutely can pay the funding fee in cash at closing, the vast majority of borrowers choose to roll it into their total loan amount. So in our first example of the $400,000 loan with a zero down payment, the $8,600 funding fee would be added to the loan, making your new total loan balance $408,600. This is a huge advantage because it means you don't have to come up with that cash out of pocket. The downside, of course, is that you'll be paying interest on that fee over the 30-year life of the loan. But for most service members and veterans, the ability to get into a home with minimal upfront cost makes this a very worthwhile trade-off. Okay, so we've covered the what, the why, and the how much. But now we get to the most important part of this entire discussion. The part that could save you over $10,000 instantly. We're talking about the VA funding fee exemption. That's right. Certain veterans and service members do not have to pay this fee at all. It is completely waived. This is, without a doubt, one of the most powerful and often misunderstood benefits of the entire VA loan program. So, who qualifies for this complete waiver? The primary group of individuals who are exempt from the VA funding fee are veterans who are receiving VA compensation for a service-connected disability. This is huge. And let me be crystal clear. You do not need to be 100% disabled. You don't need to be 50% disabled. If you have a VA disability rating of 10%, 20%, any percentage at all, and you are receiving compensation for it, you are exempt from the funding fee. This saves you thousands of dollars from day one. Another exempt group are veterans who would be entitled to receive disability compensation, but are receiving retirement pay or active duty pay instead. This is a nuanced category, so it's critical to have your eligibility verified. Surviving spouses of veterans who died in service or from a service-connected disability are also exempt from paying the funding fee, provided they are receiving dependency and indemnity compensation, or DIC. This is a critical benefit for Gold Star families looking to achieve homeownership. And finally, a more recent and incredibly important addition to the exemption list. An active duty service member who provides evidence that they have been awarded the Purple Heart is also exempt from the funding fee. This was a change that went into effect to honor those wounded in combat. Now, here is a pro tip that could literally change your financial future. What happens if you're in the process of applying for disability benefits when you're buying your home? Let's say you close on your house in May, and you pay the funding fee because your disability claim hasn't been approved yet. Then, in August, you get a letter from the VA saying your claim was approved and is retroactive to a date before you closed on your home. What happens then? The VA will refund your entire funding fee. You read that right. If you have a pending claim for disability at the time of closing, and it is later approved with a retroactive effective date, you can apply to the VA for a full refund of the funding fee you paid. This is a game changer. Thousands of veterans close on a home, pay the fee, and then get their rating, not realizing they are owed thousands of dollars back. You have to be proactive and apply for the refund, but it is absolutely your money to claim. So, understanding your status is everything. Before you even start the loan process, if you believe you have a service-connected condition, you should start the process of filing a claim with the VA. Not just for the potential healthcare and monthly compensation, but because it could directly impact your home buying journey by completely eliminating one of its biggest costs. This fee, and especially its exemptions, separates the VA loan from every other mortgage product on the planet. It's the difference between needing just a few thousand for closing costs versus needing well over $10,000. But knowing your fee status is only half the battle. How do you actually prove to a lender that you're eligible for a VA loan in the first place? And more importantly, how do you prove you're exempt from the funding fee? It all comes down to a single critical document issued by the VA itself. This document is the key that unlocks the entire process, and if it has an error on it, your home purchase can grind to a halt. It's called the Certificate of Eligibility, or COE. So what exactly is this document, and why does one piece of paper hold so much power? Think of the Certificate of Eligibility as your official military hall pass for a home loan. It is the single authoritative document that tells a lender two critical things. First, it verifies that you, the veteran or service member, have met the minimum service requirements to be eligible for the benefit. It's the VA's stamp of approval on your service record. Second, and this is the part that really matters to the bank, it specifies the amount of your available loan entitlement. Now that word, entitlement, is where a lot of people get confused. They hear the word and think it's the maximum amount of money they can borrow. That is absolutely not the case. VA loan entitlement is not a dollar amount you can borrow. Instead, it's a dollar amount the VA guarantees on your behalf. It's the promise the VA makes to your lender, saying, "Hey, if this veteran defaults on their loan, we've got your back up to this amount." This guarantee is what makes lenders feel secure enough to offer you a loan with zero down payment and no monthly mortgage insurance. Let's break it down. Every eligible veteran starts with what's called basic entitlement, which is $36,000. I know what you're thinking. $36,000? What kind of house can I buy with that? But remember, that's not the loan amount, it's the guarantee. The VA generally guarantees up to 25% of the loan amount. So that basic entitlement of $36,000 is enough to cover the VA's 25% guarantee on a loan of up to $144,000. For many years, that was the effective limit for a zero-down VA loan. But home prices have skyrocketed since then. $144,000 doesn't go very far in most parts of the country today. And this is where the VA loan has evolved to become so incredibly powerful. The VA introduced a second layer, often called bonus entitlement or Tier 2 entitlement. This additional entitlement allows the VA to guarantee 25% of a loan amount well above that old $144,000 mark. How high can it go? It's tied to the conforming loan limits set each year by the Federal Housing Finance Agency, which vary by county. In most of the country for 2024, that limit is $766,550. In high-cost areas like parts of California, Virginia, or New York, it can be over $1.1 million. If you have your full VA loan entitlement, the VA will guarantee 25% of a loan all the way up to that limit, allowing you to buy a home in that price range with absolutely zero money down. That is a life-changing benefit. Your COE is what tells the lender you have this full power available to you. It's the proof that your full entitlement is intact, meaning you've either never used your VA loan benefit before, or you've paid off a previous VA loan and had your entitlement fully restored. So, how do you get your hands on this golden ticket? The great news is, it's usually incredibly simple. The fastest and most common way is to just let your lender do it for you. Any VA-approved lender has access to a VA online system called the Loan Guarantee Service, or LGY. In most cases, they can input your information, your name, social security number, and date of birth, and have your certificate of eligibility generated in a matter of seconds. It's a seamless part of the pre-approval process. For the vast majority of veterans, this is all you'll ever need to do. But let's say you want to get it yourself, maybe before you've even picked a lender. You can do that too. You can log into your va.gov or eBenefits account online, navigate to the housing section, and request your COE directly. You might need to upload a copy of your discharge papers, your DD-214, but the process is straightforward. And finally, there's the old-school method, filling out VA Form 26 to 1880 and mailing it in. This is by far the slowest option and can take weeks, so it's really only a last resort if you can't get it done online or through a lender. Now, while getting the COE is usually easy, it's also the first place where major problems can surface. And these problems can stop your home purchase dead in its tracks. Imagine this scenario. You've found the perfect home. Your offer was accepted. You're under contract, and the clock is ticking on your closing date. Your lender goes to pull your COE and it comes back with a message, ineligible. Your heart sinks. Why? It could be a simple clerical error from decades ago. Maybe your character of service is listed incorrectly in the VA system, or the dates of your service are off by a single day. Suddenly, you're not shopping for furniture. You're scrambling to get your official military records corrected, a process that can take weeks or even months, almost certainly causing you to lose the house. This is why it's so critical to work with a lender who is an expert in VA loans. An experienced loan officer will often advise you to get your COE pulled at the very beginning of the process, just to make sure there are no surprises down the road. Another major issue that can appear on a COE is a problem with your entitlement. Let's say you used your VA loan benefit years ago to buy a home. You later sold that home, but the VA loan was assumed by the person who bought it from you. Or worse, maybe you went through a tough time and that previous VA loan ended in a foreclosure or a short sale. In these cases, your COE won't show your full entitlement. It will show your remaining entitlement. A portion of your benefit is still tied up in that old property. This doesn't necessarily mean you can't get another VA loan, but it does mean the math gets more complicated. Your zero down payment power might be limited. The lender will have to perform a complex calculation to figure out the maximum loan you can get with no money down based on your remaining entitlement and the conforming loan limits in your county. If the house you want to buy costs more than that calculated amount, you'll be required to bring a down payment. It's a solvable problem, but it's a shock if you're not expecting it. Your COE is the document that reveals this history to your lender. It's also important to know that eligibility isn't just for veterans. In certain tragic circumstances, the surviving spouse of a veteran may be eligible for a VA home loan. If the service member died in the line of duty or as a result of a service-connected disability, their unmarried surviving spouse may be able to use this benefit. Obtaining a COE in this case requires more documentation, things like the veteran's death certificate and the marriage certificate, but it is a profound and vital extension of this benefit to the families who have sacrificed the most. The certificate of eligibility, then, is far more than just a pre-qualification form. It is the story of your service, translated into the language of real estate finance. It is the official record of your sacrifice and the key that unlocks the door to one of the most powerful financial tools you have ever earned. It confirms your right to be at the table. Once you have it and it's correct, you've cleared the first major hurdle. You've proven you are worthy of the benefit. But the VA's involvement doesn't stop with you. They don't just guarantee a loan for any property. The house itself has to meet the VA's unique and very strict set of standards. If your dream home fails this next test, the entire deal could collapse, no matter how perfect your COE is. This next critical hurdle is called the VA appraisal. And it's far more than just a simple valuation to determine a home's price tag. It's a deep dive into the safety, security, and structural integrity of the property, and it can make or break your purchase. Think of the VA appraiser not as a judge, but as the most experienced grizzled squad leader you've ever had. The one who checks your gear, your map, and your plan 3 times over before you step off the line. Their mission isn't to stop you from buying a house. Their mission is to stop you from buying the wrong house. This entire process is built on a foundational promise from the Department of Veterans Affairs. We will not guarantee a loan on a property that is unsafe, unsanitary, or structurally unsound. They are putting their financial backing on the line, and more importantly, they are protecting the veteran from stepping into a financial landmine. Unlike a conventional appraisal, where the lender hires an appraiser primarily to justify the loan amount, the VA appraiser is an independent, third-party professional assigned from a VA-approved roster. You don't choose them. The seller doesn't choose them. The lender doesn't choose them. This impartiality is a feature, not a bug. It ensures their only loyalty is to the facts on the ground and the VA's strict standards, which are known as the Minimum Property Requirements, or MPRs. So let's break down this 2-part mission. First, the appraiser determines the home's fair market value. They look at comparable recent sales in the area, the comps, to make sure the price you agreed to pay is reasonable. If you offered $400,000, but the appraiser determines the house is only worth $380,000, the VA will only guarantee a loan up to that appraised value. This protects you, the veteran, from being immediately underwater on your mortgage, owing more than the house is worth from day one. But that's the simple part. The second and far more critical part of their mission is ensuring the home meets those minimum property requirements. This is where the VA loan truly flexes its protective muscle. The MPRs are a comprehensive checklist covering the 3 S's: safety, soundness, and sanitation. Let's start with safety. The appraiser is looking for anything that could pose a direct threat to you and your family. Is there exposed electrical wiring? Frayed cables? That's an automatic red flag. Are there handrails on all staircases with more than a few steps? It sounds minor, but a fall can be devastating. They'll check for peeling or chipping paint in any home built before 1978 because of the risk of lead-based paint, which is incredibly toxic, especially to children. The property must have a continuous, safe, and private access route from a public street. You can't have a situation where you have to cross someone else's private land just to get to your own front door. Next is soundness, the structural integrity of the home. This is where big-ticket nightmares are caught. The appraiser will walk the property, looking at the very bones of the house. Is the foundation crumbling or showing major cracks? That's a deal stopper. How's the roof? It must have a reasonable amount of life left in it and show no signs of active leaks. A roof that's going to need a $20,000 replacement in 6 months is not a sound investment for a veteran. They'll look for evidence of termite infestation or rot. In many regions, a separate pest inspection, often called a termite report, is mandatory. If they find active termites, treatment is non-negotiable. The VA is essentially saying, "We will not let you buy a home that is actively being eaten from the inside out." They'll check to ensure the crawl space is properly ventilated, and the attic isn't showing signs of water damage. This isn't just a glance. It's a trained eye looking for the subtle signs of a home in distress. Finally, we have sanitation. This covers the basic necessities for healthy living. The property must have a reliable source of safe drinking water, whether from a public utility or a private well that has been tested and proven safe. It must have a functioning, adequate sewage disposal system. If it's on a septic system, that system has to be in good working order, not failing or backing up into the yard. The home must have a working water heater that provides hot water and a permanent, adequate source of heat. You can't use a few space heaters to qualify. It needs a real heating system capable of keeping the home comfortable. They'll also check for any signs of dampness, mold, or mildew, which can cause serious health problems. So what happens when the appraiser finds an issue? This is where so many people panic, thinking the deal is dead. But that's not the case. If the home fails to meet NPRs, the appraiser issues what's called a Notice of Value, or NOV. This report will list the appraised value and any required repairs that must be completed before the loan can close. And this is where you gain an incredible amount of leverage. You now have a formal report, backed by the authority of the VA, detailing exactly what's wrong with the house. This isn't just your opinion or your home inspector's opinion. It's a list of mandatory fixes. You then go back to the seller with this report. The most common outcome is that the seller agrees to pay for and complete all the required repairs. They want to sell their house, and now they have a clear official punch list of what needs to be done. Once the work is completed, the appraiser comes back out for a final inspection to certify that the home now meets VA standards. What if the seller refuses? You still have options. In some rare cases, a buyer might be able to fund the repairs themselves, but this can be complicated. More often, this is your sign to use the ultimate form of protection the VA appraisal gives you: the ability to walk away scot-free. Your contract likely has a contingency clause for the VA appraisal. If the property doesn't meet the standards and the seller won't fix it, you can cancel the contract and get your earnest money deposit back. The appraisal just saved you from buying a money pit. There's a persistent myth that sellers are afraid of VA offers because the appraisal is too tough. Let's reframe that. The VA appraisal isn't tough. It's thorough. It doesn't kill deals, it kills bad deals. It stops veterans from making the biggest financial mistake of their lives. In a hot market, you see conventional buyers waiving inspections, waiving appraisals, and taking on enormous risks. They might win the house, but a year later they're facing a $30,000 foundation repair they never saw coming. The VA loan doesn't let you make that mistake. It forces a standard of quality that protects you whether you know you need it or not. The appraiser is your unseen advocate, your objective expert, ensuring the home you're about to commit hundreds of thousands of dollars to is safe, sound, and worth the price. Once the appraisal comes back clean with a value that supports the loan and all NPRs met, a huge weight lifts off your shoulders. The property itself is now officially cleared for landing. The house has passed the test. But there's one final gatekeeper in this entire process. This person doesn't walk the property or look at comps. They sit in an office and scrutinize every single piece of paper associated with your life and this loan. They examine your income, your credit, your assets, the appraisal, the title report, everything. They hold the final key to your new home. This is the loan underwriter, and their decision is the last and most important step in your journey from borrower to homeowner. And that underwriter, they don't know you. They don't know your story, your service, or your dream of that backyard for your kids. All they see is a file, a collection of numbers and documents on their desk that must tell a perfect, risk-free story. Their job isn't to help you buy a house. Their job is to protect the lender from making a bad investment. It sounds harsh, but it's the reality of the system. They are the final gatekeeper, and their scrutiny is intense. They'll re-verify everything your loan officer already did. They'll run your numbers through sophisticated software, but they'll also use their own experience to look for red flags. Does your income seem stable? Are there any recent, large, unexplained deposits in your bank account? That could look like a loan from a friend that you haven't disclosed, which is a big no-no. Did you suddenly open 3 new credit cards right after you got pre-approved? That changes your debt-to-income ratio and signals potential financial distress. The underwriter is a detective, and your loan application is the case file. They're looking for consistency. The name on your driver's license must match the name on your bank statement, which must match the name on your pay stub, which must match the name on your certificate of eligibility. Every I must be dotted, every T must be crossed. If you just got a big raise, they'll want to see not just the offer letter, but proof it's hit your bank account. If you have a gap in your employment history, they'll want a detailed letter of explanation. Their entire purpose is to eliminate any shadow of a doubt. This is often the most stressful waiting period for a homebuyer. You've done everything right, you've found the perfect house, but your fate is in the hands of a stranger in an office you'll never see. But then an email or a phone call comes through from your loan officer. But it might not be the news you expect. It's not a yes or a no. It's a conditional approval. Don't panic. This is completely normal. In fact, it's the most common outcome of the first underwriting review. A conditional approval means the underwriter is saying, "I'm ready to approve this loan, if you can provide me with a few more things." These are called conditions, and they are the underwriter's final checklist items. The conditions can be simple. Maybe they need your most recent pay stub because a new pay period just passed. Maybe they need a clearer copy of your driver's license. Maybe they need you to write a letter explaining why you had a credit inquiry from a car dealership 6 months ago, even if you didn't buy a car. Sometimes the conditions are more complex. They might need to verify the source of a large gift deposit from a family member, requiring gift letters and bank statements from the person who gave you the money. They might want proof that an old collection account has been paid off. Your loan officer will guide you through this. You'll work together to gather these final documents to clear the conditions. This is the final sprint. You get them the documents, they send them to the underwriter, and then you wait again. It might be a few hours, it might be a day. But then the final verdict comes. And it comes in the form of 3 of the most beautiful words in the English language for a homebuyer: clear to close. That's it. The finish line. The underwriter has given their final, unconditional approval. The lender is ready to wire the money. The dream is no longer a dream. It's a scheduled appointment. This is the moment of pure relief. All the stress, the paperwork, the waiting, it was all worth it. Now you move to the closing table. This is the formal process of transferring ownership of the property. It's usually held at a title company or an attorney's office. You'll be there, maybe your real estate agent, the closing agent, and sometimes the seller. The first thing you'll do is provide your identification and the certified check for your closing costs and any down payment you chose to make. Then comes the mountain of paper. You're going to feel like you're signing your name 100 times. And you probably are. But there are 2 documents that are the most important. The first is the closing disclosure, or CD. You should have already received a preliminary version of this at least 3 days prior to closing by law. This document itemizes all the final numbers. It shows the loan amount, the interest rate, the monthly payment, the closing costs, the taxes, the insurance, everything. Your final CD at the table should match the one you already reviewed. Compare them carefully. This is your last chance to catch any errors. The second key document is the promissory note. This is your official IOU to the lender. It's the legal document where you promise to repay the loan. You're also signing the deed of trust or mortgage, which is the document that secures the property as collateral for the loan. If you don't pay, this is what gives the lender the right to foreclose. It sounds scary, but it's standard for every single home loan in America. You'll sign and sign and sign. Once all the papers are signed by you and the seller, the closing agent will begin the final steps. They will notarize the documents, make copies, and most importantly, they will coordinate the funding. This is when your lender wires the loan amount to the title company. The title company then uses that money, plus the money you brought, to pay the seller and anyone else who is owed money, like the real estate agents. Once the money is confirmed to have been received and disbursed, a process called funding, and the new deed is officially recorded with the county, you are officially, legally, the owner of the home. And that's when the closing agent slides a small metallic object across the table. The keys. Holding those keys for the first time is a feeling you will never forget. They feel heavier than they should. They represent so much more than just access to a building. They represent stability, security, place to call your own. They are the tangible result of your service to this country, and a promise fulfilled by the VA Home Loan Program. Walking up to that front door, putting that key in the lock, and hearing that click as it turns. That's the moment. Stepping across that threshold is not just entering a house. It's entering a new chapter of your life. A chapter you built. A chapter you earned. And let's take a moment to reflect on how you got here. You did it with 0 down payment, freeing up your cash for furniture, for moving expenses, for life. You did it without paying a single dollar in monthly private mortgage insurance, saving you $hundreds every single month for the life of your loan. You did it with a competitive interest rate, often lower than conventional loans, because the government's guarantee made you a less risky borrower. You did it with limitations on what you could be charged in closing costs. This program, this incredible benefit, was designed in 1944 as part of the GI Bill. It was created to give veterans a tangible foothold in the country they returned to. It was designed to build wealth, to create stability for military families, and to honor their sacrifice in a meaningful, practical way. And the best part? This benefit doesn't expire. You can use your VA loan entitlement over and over again. You can buy a home, live in it, sell it, and then use your fully restored entitlement to buy another one. Or if you have remaining entitlement, you can even own more than one home with a VA loan at the same time. And when interest rates drop, the VA offers one of the simplest and most powerful refinancing options on the planet: the Interest Rate Reduction Refinance Loan, or IRRL. It allows you to lower your rate and payment with minimal paperwork, sometimes without even needing a new appraisal. This isn't just a one-time perk. It is a lifetime financial tool. It's a key that can unlock doors for you and your family for the rest of your life. It is a testament to a promise made by a grateful nation. So, if you are a veteran on active duty or a surviving spouse, and you dream of owning a piece of the country you served, know that this is not just a possibility. It is a pathway that was paved specifically for you. It can seem complex, even daunting, but every step is manageable, and the reward is immeasurable. This isn't just a loan program. It's a key to the American dream you fought to defend. It is your benefit. You earned it. Now go claim it.